In this lecture, we are going to discuss emergence of financial instability in the post-war era. This particular lecture is based on a book by Hyman Minsky called Stabilizing an Unstable Economy, and this is based on chapter 4 of that book. Now, the instability that we see in the financial sector in the United States didn't start today or in the last 10 years. The change started happening during the post-World War II era. And we'll try to understand what motivated those changes and why today the financial sectors are so unstable compared to yesteryears. Before we go into details, let's try to get with few definitions so that we are all on the same board. First is the definition of the word position. What is position in a financial balance sheet? These are assets that cannot be used readily to generate cash, such as physical plant of operating firms and loans in portfolios of banks. Because these assets cannot be transitioned or changed into cash very easily, unlike other forms of assets such as the cash in the vault, which is itself is a cash, or in some cases treasury bills, which are highly tradable. And again, once more, what are treasury bills? These are the bonds or short-term bonds issued by the United States government. There's another definition I want to make clear is position making. So there's a difference between position versus position making. What is position making? This is the act of acquiring cash to finance the assets essential to a unit's business. The instrument used for such purposes is the position making asset or debt. So basically, if a financial institution or any kind of firm needs cash, they can transform these assets into cash. This is called position making. Now we are going to focus on the evolution of bank position making instruments, especially since the World War II. So let's start with the very beginning. In the beginning, the primary position making instrument was the Treasury bill, which we all know are highly tradable. Banks held these position making instruments to carry out their day-to-day transaction. And mind you, these treasury bills also earned returns for the banks. US government do pay interest on their bonds. The buying or selling of treasury debt by banks and large-scale holders of cash requires that a set of dealers exist who buy and sell the instruments for cash, and there are dealers all the time in the financial world because US government debt or bonds is the safest form of investment in the whole world, and that's been true since the World War II. However, here's the problem. Problem is this: holding treasury debts are not highly profitable for banks due to lower yields. Often we all know treasury bills doesn't have very high yield compared to other forms of investments. So this is not very profitable for banks to hold a lot of treasury bills. So that's why banks have been looking for some innovative ways of reducing their reliance on treasury bill to increase their returns on their assets. And mind you, when banks buy these treasury bills, shows up in commercial banks' balance sheet. Let's now focus on what happened to the assets of the commercial banks since World War II. So what I have shown here is the years, and I'm more interested in this government over financial assets and then loans over financial assets. Now, if you remember the assets of a balance sheet of a commercial bank, they can use the liability, that is depositors' money, either to buy government bonds or to loan it out. Both are assets for a commercial bank. The loans are more profitable because they earn higher interest rate, but they are also more riskier and less liquid. On the other hand, banks also like to hold a lot of treasury bills, which are government portion of the financial asset. This means when I say government, these are government treasury bills, TBs or treasury bills. Now what we see here in 1946, then since when the data is available, banks were holding in the United States, about 50% of the assets in Treasury bills, only 17.9% of the assets in loans. And see what happened since then. Now this data kind of ends in 1984 because Hyman Minsky was writing this book in the early 1980s. That's why the data ended up there, and the trend remained pretty much the same since the World War II. So what we see is a gradual decline in the banks holding of treasury bills, which are super safe but very low returns. On the other hand, look at the increase in the loans of the banks. So in 1946, they were holding only 17.9% of the assets as loans. By 1984, they are holding 65.8% of the assets as loans, which increase banks' profits, but at the same time it increase risk, and also it create problem for liquidity because you cannot just call back your loan very easily. So let's continue with this discussion of the evolution of position making instruments. So in the post-war era, an alternative to treasury security market as a position making market for commercial banks appeared with the development of the federal funds market. Now banks wanted something more liquid, and that's why they developed something called the federal funds market. If you remember, federal funds are deposits at the Federal Reserve Bank. By the middle of the 1950s, it became common for banks to use them as position-making instrument using something called the federal funds rate. Just to be clear once more, federal funds market are highly liquid, so banks can borrow from each other to carry out their day-to-day business if they run short of cash. And this is the way they try to manage the risk that was associated with too much of loans in their assets instead of treasury bills. Because treasury bills are safe, they are highly liquid, but they don't yield so much of returns. So bank assets have grown relative to bank holdings of deposits at the Federal Reserve and vault cash. So percentage of vault cash and reserves at the Federal Reserve to total bank financial assets fell from 13.6% in 1946 to 2% in 1984. So what does it mean? Let's look into the data. So I'm going to focus on this particular data or series, and again this is the year. So year goes from 1946 to 1984, and this is in 1946 banks were holding 13.6% of their assets in cash. That means they were holding whatever deposits they have or whatever assets they have, 13.6% was in hard cash, which is the vault money which they can always use to carry out their day-to-day expenses. However, it's very unprofitable for banks to hold cash because cash don't earn any interest if it's just lying in your vault. So what banks started doing? They started holding less and less cash. By 1984, that number dropped to 2%. So 2% of their assets. So mind you, we are looking at the assets, which is the left-hand side of a balance sheet of a bank. So nowadays, banks are holding very little cash compared to their assets because it's very less profitable. But here is the problem. When they hold very little cash, now if they run out of cash, what they do? They go to the federal funds market where they can borrow from each other. So banks basically trying to take care of the risk by pulling all the money in the federal funds market. And that was very profitable for the banks, and it was a very collective decision. However, here's the problem. Problem is this: when bad times strike, now banks become very cautious and that market dries up pretty easily. I'll come to that in a bit. Obviously, they also went through more innovations in these position-making instruments. For total assets to have increased related to the reserve deposits and vault cash, what commercial banks did, they started developing other reserve economizing type of liabilities, and one such was the certificate of deposit, which is your CDs, especially large denomination CDs. Though what they started doing, they started selling these CDs. And what are CDs? These are nothing but bonds sold by the bank, and people like you and me often buy these stuff as a way of investing our money. Another technique used by government bond dealers and commercial banks to make position is the repurchase agreements. And what are repurchase agreements? These are also called repos. These are an arrangement whereby the Fed or another party purchase securities with the understanding that seller will repurchase them in a short period of time, usually less than a week. So here, what banks started doing, if they hold certain kind of assets, especially government bonds, they can sell it with the intention that they'll buy it back. And why they'll sell it? If they're running short of cash, they can sell it to get the cash to carry out the business today. And when tomorrow they have to buy it back by paying the bank or other financial institution who bought those repos. Banks also engage in with foreign banks to make position through euro dollars. And what are euro dollars? These are US dollars that are deposited in foreign banks outside the United States or in foreign branches of US banks. Again, this is a way they are trying to generate cash in case they run short of cash. Why they ran short of cash? Because they were holding very little cash, because cash doesn't generate any returns for a bank. So the greater number of alternative position making techniques available for banks and for other financial institutions, the slower the reaction of supply of finance to monetary policy of the Federal Reserve. So what does it mean? It means that when banks run out of cash in a financial crisis situation like 2009 or what's going on right now in the US economy because of the coronavirus pandemic, banks suddenly realizing there's not enough cash available in the market. So even if Fed tries to inject cash, they don't have any liquid assets which they can transform into cash. That's why Fed started doing all these non-conventional monetary policies, where they are trying to give banks by buying their mortgage-backed securities in the 2008-2009 crisis during the Great Recession, or even today, recently Fed announced that they will be buying all sorts of securities to generate cash for the banks. Now, what it essentially did, it essentially increased the risk. So the financial system evolved over the post-war period. The potential for instability of the economy increased. And why it increased? Because type of assets the banks are holding. In the old days, right after World War II, they were holding a lot of government bonds, which are super safe but very low returns. What they did then, they started reducing those holdings or those positions, to be specific. And they started giving out more loans, and to ensure that there's enough liquidity, they developed the federal funds market, repos, or euro dollars. All these are designed to ensure enough liquidity in the financial sector, but all of these things becomes problematic, especially during the trying times of a crisis, because nobody trusts each other, but everybody trusts the US government with the bonds, and often these banks are not holding enough of those bonds.